Welcome to this explainer. Look, if you're running a business or managing the books, you already know superannuation isn't just another line item. It's a strict compliance mandate. Today, we're skipping all the fluff and diving straight into the exact mechanics. We're going to cover the operational rules, the specific accrual math, and the precise journal entries you absolutely need to keep your ledger balanced and the auditors far, far away. Let's get started. So, here's our roadmap for today. We'll quickly recalibrate on the basic definitions in Section 1, move right into your daily operational playbook in Section 2, open up the ledger for the nitty-gritty accounting in Section 3, and then wrap things up with some crucial compliance guardrails in Section 4. All right, Section 1, what is superannuation? Let's get right into the foundational stuff, looking at this strictly from a business obligation standpoint. To really ground us, let's establish a baseline. What actually is superannuation, or super as it's commonly called? Well, at its core, it's a legally established investment vehicle holding retirement savings. But for you, the employer, it is primarily a non-negotiable statutory obligation. You are legally mandated to calculate and contribute a specific percentage of eligible earnings directly into this vehicle. Essentially, you're turning a portion of your payroll into a locked retirement asset. Now, you might be wondering, where does that money actually go? Usually, it heads to one of four destinations. First, you've got industry funds. These are typically your massive not-for-profit giants like Australian Super or Host Plus. Second are retail funds, which are run by financial institutions. They offer broader choices, but, often come with higher fees. Third, we have corporate funds, which are tailored arrangements specifically for your workforce. And finally, self-managed super funds, or SMSFs. These give the employee absolute control over their investments. But remember, with great power comes a whole lot of compliance. Okay, moving on to Section 2, the employer's playbook. Let's translate those definitions into what you actually have to do day to day. Let's look at the math, because this is really where the rubber meets the road. With the standard statutory rate currently sitting at 12%, the calculation is pretty direct. Say an employee's eligible monthly gross salary is 5,000 Australian dollars. You are legally obligated to calculate 12% of that. That means an extra $600 leaves your business and goes straight into their nominated fund. I want to be super clear here. This isn't deducted from their pay. It is a significant additional payroll cost that you absolutely have to forecast for. So ensuring that $600 lands safely, that requires a strict four-step life cycle. Step 1 triggers on day 1 of employment. The employee nominates their fund or they default to yours. Step 2 hits every single payroll cycle, where you isolate those eligible earnings and apply that 12% rate. Step 3 is the actual cash transfer, typically routed quarterly through a clearinghouse. And Step 4? That's your ongoing vital reconciliation to prove to the authorities that your numbers tie out perfectly. Let's jump to Section 3, accounting and journal entries. For all the accountants and bookkeepers out there, this is where things get highly practical. In the accounting world, superannuation strictly follows the accrual principle. What does that actually mean for you? Well, it means you've got to recognize that financial obligation in your books the absolute moment the employee earns it, even if the cash won't actually leave your bank account until the end of the quarter. It hits your books in two ways simultaneously: as an employee benefit expense that reduces your profit, and as an employer liability showing that, hey, you owe someone money. This scenario right here perfectly illustrates that accrual principle in action. Let's say you have a $50,000 monthly payroll that generates a $6,000 super obligation. You immediately debit your super expense by $6,000. This hits your P&L and shrinks your profit. Simultaneously, you credit super payable by $6,000. That's your liability. Think of it like a bright red flag on your balance sheet, constantly reminding you that you owe this cash to the clearinghouse. Now, fast forward to the end of the quarter when the cash actually moves. Now the journal entry flips. You debit the super payable account by $6,000, totally extinguishing that liability. Then you credit your bank account by $6,000, which reflects the physical cash finally leaving your business. Just like that, the red flag is gone. Let's pull the lens back for a second and bring it all together into a master combined payroll entry. Just look at how beautifully this balances. You've got your salary expense debited at $50,000 and your superannuation expense debited at $6,000. Then on the credit side, you're withholding $8,000 for PAYG taxes, logging that $6,000 super payable liability, and finally paying out $42,000 in net cash to your employees. Every single dollar is perfectly accounted for. When you really zoom out, you see the massive impact this all has on your balance sheet and your cash flow forecasting. Before payment, your current liabilities are stacked high with super, payroll tax, and PAYG. It might look like you're sitting on a ton of cash, but you're really sitting on obligations. After payment, the super liability vanishes, which is directly mirrored by a drop in your available cash. This is exactly why real-time, highly accurate ledgers are literally the only way to know your true actionable cash position. Which brings us to Section 4, Risks and Best Practices. Let's step back and look at the guardrails. What happens when things go wrong? And how do you protect yourself? Look, when this system breaks down, the regulatory consequences are completely unforgiving. Miss a quarterly deadline, you are instantly hit with late penalties, compounding interest, and a mountain of remedial reporting. Miscalculate the base by accidentally omitting a bonus, that's an underpayment breach. And finally, failing to maintain pristine documentation is what transforms a routine inquiry into the absolute nightmare of businesses everywhere: a full-scale audit and employee disputes. Nobody wants that. Fortunately, there is a pretty bulletproof defense against these risks: uncompromising best practices. The absolute non-negotiable step today is automating your payroll processing. Modern integrated software automatically isolates eligible earnings, applies the exact statutory rate, and routes the funds directly to clearinghouses. If you combine that automation with strict monthly ledger reconciliations and pristine employee records, your compliance risks drop to near zero. So we've covered a lot of ground today, and that brings us to the ultimate takeaway for your operations. I want you to ask yourself right now, are your business's superannuation processes fully automated, accurately reconciled every single month, and completely audit-proof? If you hesitate to answer yes to any of those, I highly encourage you to take what we've covered today and stress test your own payroll setup. Secure your ledger, secure your compliance, and most importantly, secure your team's future. Thanks so much for joining me on this explainer, and keep learning.